The collapse of crypto bank Silvergate and the termination of the Silvergate exchange network pose a challenge for the crypto industry, according to a new report from JP Morgan. And our next guest says there were numerous red flags at Silvergate Bank that nobody seemingly noticed. Joining us now to discuss is co-founder of investment management Rosetta Analytics, Angelo Calvello. Angelo, good morning. So you wrote an op-ed and you state that analysts had these rosy recommendations for Silvergate that provided it with a veneer of institutional legitimacy, but you say there were red flags that they missed. So what were they saying and why were they missing the warning signs?
Good morning. When I looked at Silvergate, and I am not a bank analyst or a sell-side analyst, I'm just a guy that kind of thinks about things. What I saw was that from the very beginning of the pivot, when Silvergate moved from being a traditional regional bank to being a crypto bank, there were some underlying problems. Specifically, when you look at the pivot, there was no acquisition involved. You had a regional bank suddenly moving into crypto without having any crypto competency. And beyond that, there was no capital investment made to bolster the existing regional bank's opportunity. That was the first thing I saw. And then I kind of looked through and said, boy, you know, the client base for this regional bank is really a crypto client base. And those crypto investors have different needs, certainly needs that were met by the Silvergate exchange network, but they had a different disposition in the sense that now you looked at Silvergate and they were holding assets that had tremendous volatility, crypto assets. And that presented a problem also long before the FTX. And then I'll just mention the final piece is the Silvergate exchange network is certainly the on-ramp and off-ramp in some cases for dealing with crypto. But I'm not sure that Silvergate had the necessary compliance supervisory oversight of the activities. And it turns out there's evidence that they did not.
Yeah, Angelo, when I talk to people in the fund management industry, there were a lot of people for a long time who have been trashing Silvergate, and they've also been trashing the analysts. They say the analysts weren't really looking at the balance sheet, that they use terms like lazy, that they were not, that they weren't, you know, their models were ridiculous, that they kind of were making assumptions just based on, you know, small amounts of data, past this, you know, growing things the way, you know, without even thinking about the risks involved. And then ultimately, they weren't looking at the balance sheets. They weren't looking at what would happen in a rising rate environment, which we're seeing affecting not just Silvergate, but Silicon Valley Bank now and other banks, that rising rates, which a lot of these guys that manage these banks are young and they don't remember a world where you had the risk-free rate above 5%. Those of us who are a little bit older remember that life. And ultimately, that this is kind of what the problem is. Do you think that the analysts involved here didn't do their homework properly, or do you think that they were swayed in some level to keep relations with Silvergate on an upbeat, if you will? Why do you think the analysts ignored the criticisms that they were facing, not just from the investment community, the institutional investment community, but even, you know, I'll say the citizens on the Reddit and all these on all these sites that have been trashing the analysts and saying, hey, you guys aren't doing the work?
I'm not sure I could talk to motivation. The argument I made was that you have sell-side analysts that follow a very specific career path, and they're trained in traditional finance. My argument is when Silvergate pivoted into crypto, you needed to look at Silvergate through a DeFi lens, where what you had with these analysts, and I believe that, you know, they're hardworking people, and I don't think they're compromised in the sense that, you know, they're very close to the CEO or there was, you know, some motive other than just good hard work. They couldn't see it. You know, when you're trained as a CFA or a Series 7, you're not looking through and understanding the crypto volatility. You're not understanding the, the use of collateral. You should. I understand that.
They should. And even the CFA court. I'm going to defend the CFAs because. Yeah.
Are you a CFA? Tell me. Come on, give it up.
CFA chart. Yes, CFA charter holder. We have to say charter holder because we can't call ourselves CFAs. We have to say charter holder. But yeah, but the thing is that and this goes back to the lazy point, which is one of the things you had to do is you always have to look at the risks of the assets involved. And the point is that if they are viewing this as a perpetually money printing, like this thing is always going to go up because it went up the past 2-3 years. Therefore, it's, just that's laziness, isn't it? I mean, it's not doing probabilities and running Monte Carlo analyses of what could happen if things go wrong. I mean, like this seems just straight up like, previous sell times 1.3. To grow every time.
But if you're going to run those analyses, you need to understand what the risks are. And I'm not sure they fully understood the risks related to the volatility of the crypto market. You're right. You could run the risk and develop these rosy scenarios, but you got to understand what the risks are. And the risks are different at this bank, especially when they made this pivot without having any clear, let's call it DeFi competency brought in. And so I don't know if I want to call them lazy as much as they have a blind spot that they should work on. That's really the issue I was trying to make, that these issues were there, but they were just missing them partly because of their training and partly because I think that there was just a giddiness, but I don't think it was laziness, Lawrence. I wouldn't want to incriminate them with that.
Yeah, so you also state that some are quick to point out that Silvergate is a banking failure, not a crypto failure, and you see it as another TradFi failure. So first of all, I guess, what do you mean by that? And will this have an impact similar to on Signature Bank or Silicon Valley Bank if it's not a banking failure per se?
I'm looking at it that when I talk about it being another TradFi failure, I think back to FTX and Celsius and how you had some of the most sophisticated institutional investors in the world make commitments to those institutions. And there were plenty of red flags there from a traditional due diligence sense. So if we just stay with Celsius and FTX as an example, if we would have seen these savvy institutional investors perhaps dig a little deeper, they may not have made those investments and they may not have provided the legitimacy that those entities needed to go out and continue to engage in their business. It's the same idea here where you have financial analysts looking at Silvergate through a traditional lens and they missed it, in my view. And there were opportunities because we saw some short sellers publicly state that there were some shortcomings with the AML, for example. So that's the point. It's like we've got to get people to look at the institutional investors to look at crypto investing, DeFi through the right lens, to understand the risks and the opportunities instead of looking at it through a traditional lens.